You've probably heard this rule everywhere. Never risk more than 2% per trade. But most beginner traders misunderstand what this actually means. They think 2% is the money they should use to enter a trade. That is completely wrong. Today I'll explain what risk 2% really means, using very simple math. No confusion, no advanced formulas.
In this video, I'll show you exactly how to calculate position size so that you never risk more than 2% of your capital on a single trade. You'll also learn how to use leverage effectively without increasing your risk. We'll start with very simple examples and then move on to real-world examples for both long and short trades so you can truly master the concept. Along the way, you'll clearly understand what margin is, what liquidation price means, and why they matter. And at the end of the video, we'll wrap up with practical risk management best practices that you can start using immediately.
Let's say your trading capital is $1,000. Many beginners think, okay, 2% of $1,000 is $20. So I should only use $20 to buy the asset. That is not risk management. Risk is not how much money you use to open the trade. Risk is how much you lose if your stop loss is hit. Here's the key idea. Risk means maximum possible loss, not position size. When traders say risk 2%, they mean if this trade fails and hits the stop loss, I will only lose 2% of my total account, nothing more. It doesn't matter if you use leverage. It doesn't matter how big your position is. Only the loss at stop loss matters. Now let me explain this with a simple step-by-step example using simple numbers. This example is for a long position. I will show a short position example after this. First, our account details. Account balance, $1,000. Maximum risk per trade, 2%. So the maximum allowed loss is 2% of 1,000 equals $20. This $20 is your maximum pain for this trade. How did we calculate the maximum loss as $20? We multiplied 1,000 by 0.02. If our maximum risk was 1%, we would multiply 1,000 by 0.01. If our maximum risk was 5%, we would multiply 1,000 by 0.05. After we find the maximum allowed loss, the next step is to calculate risk per unit. Here's the trade setup for a long. Entry price, 1,000. Stop loss, 800. Take profit, 1,600. So risk per unit equals entry minus stop loss. 1,000 minus 800 equals 200. Risk per unit is the distance between entry and stop loss. For a long trade, risk per unit equals entry minus stop loss. For a short trade, risk per unit equals stop loss minus entry. But the core idea stays the same. It's the distance to the stop loss. Now comes the most important part. You already decided maximum loss allowed is $20. Loss per 1 unit is $200. Now we calculate the position size. Position size equals max risk divided by risk per unit. So position size equals 20 divided by 200. That gives us 0.1 units. This means to risk only 2% of our capital, the position size we should buy is 0.1. Now let's calculate how much money is needed to buy 0.1 units. The cost of 1 unit is the entry price. That is $1,000. So the cost of 0.1 units is 1,000 times 0.1 equals $100. So in this trade, we spend $100 from our capital of 1,000 to open this long position. Now let's add leverage. If you use 20x leverage, the margin needed becomes 100 divided by 20 equals $5. If you use 50x leverage, the margin needed becomes 100 divided by 50 equals $2. That's how we use leverage. Leverage changes the margin you need, but if your stop loss is set correctly and your position size is calculated correctly, your risk is still controlled. Now, let's go for a short position example. Entry price 1,000, stop loss 1,100, take profit 600. So, risk per unit equals stop loss minus entry. 1,100 minus 1,000 equals 100. Next, we use the same formula. Position size equals max risk divided by risk per unit. We always risk 2% per trade as a habit. 2% of 1,000 is 1,000 times 0.02 equals 20. So the position size is 20 divided by 100 equals 0.2 units. Now let's calculate the capital required. Entry price is 1,000, so the cost of 0.2 units is 1,000 times 0.2 equals $200. With leverage, 10x leverage means you need $20 margin. 20x leverage means you need $10 margin. 50x leverage means you need $4 margin.
Now, before moving to real-world examples, let's take a moment to summarize what we learned. We follow 5 simple steps, right? Step 1 is finding the maximum loss you can afford. This is the maximum amount you are willing to lose on a single trade. We calculate this by multiplying account capital by risk percentage. As a good trading practice, we always keep the risk percentage at 2%. Step 2 is finding the risk per unit. For a long position, we subtract the stop loss from the entry price. For a short position, we subtract the entry price from the stop loss. Step 3 is finding the position size. We calculate the position size by dividing the maximum allowed loss we found in Step 1 by the risk per unit we found in Step 2. Step 4 is finding the margin required, or in other words, the capital needed to open the position. We calculate this by multiplying entry price by the position size we just calculated. And finally, Step 5. If we are going to use leverage, we simply divide the margin we just calculated by the leverage. This tells us how much capital is actually required when leverage is applied. Now, let's practice what we learned with some real-world examples. Here is a long trade setup from the Doge USDT chart. Let's consider the trade entry price as 0.1234 and the stop loss price as 0.1229. Assume we have $1,000 in our trading account and we are going to risk only 2% of the capital. Now, please pause this video and try to calculate the following. First, the position size we should buy for this long trade in order to risk only 2% of the capital. Second, the amount of capital required to open this trade. And third, the amount of capital required if we use 20x leverage. Okay, I hope you did the calculations by yourself. Now I'm going to do the calculations here so you can compare your results with mine. Let's start by finding the maximum allowed loss. Our capital is $1,000 and the risk is 2%. So 1,000 multiplied by 0.02 equals $20. Next, we find the risk per unit. Since this is a long trade, risk per unit equals entry minus stop loss. So 0.1234 minus 0.1229 equals 0.0005. Now we calculate the position size. We divide the maximum allowed loss, which is $20, by the risk per unit, which is 0.0005. That gives us 40,000. This means in order to maintain a $20 risk, we can buy up to 40,000 Dogecoins. Now let's find the amount of money required to buy 40,000 Dogecoins. We multiply the quantity by the entry price.
40,000 multiplied by 0.1234. Wow, that comes to $4,936. So even though our total trading capital is only $1,000, the position we want to open is much larger than that. If we still want to stick to our 2% risk rule, the only way to open this trade is by using leverage. Now let's calculate the margin required if we use 20x leverage. We divide the total position value by the leverage. 4,936 divided by 20. That equals $246.8. So with 20x leverage, we only need $246.8 from our $1,000 capital to open this trade.
Now let's look at a short trade setup from the BTC USDT chart. Let's consider the trade entry price as 87,323 and the stop loss price as 87,518. Now, let's calculate the position size we should sell in order to risk only 2% of our capital. Also, try to calculate the amount of capital required to open this trade and the amount of capital required if we use 20x leverage. Assume we have $1,000 in our trading account. Now, pause this video and try to do these calculations by yourself. Okay, I hope you did all the calculations. Now, I'm going to do them here so you can compare your results with mine. Let's start by finding the maximum allowed loss. Just like the previous examples, our capital is $1,000 and the risk is 2%. So, 1,000 multiplied by 0.02 equals $20. Next, we find the risk per unit. Entry price is 87,323 and stop loss price is 87,518. Since this is a short trade, risk per unit equals stop loss minus entry. So, 87,518 minus 87,323 equals 195. Now, we calculate the position size. We divide the maximum allowed loss, which is $20, by the risk per unit, which is 195. That gives us approximately 0.102. This means in order to maintain a $20 risk, we can sell up to 0.102 BTC. We sell, not buy, because this is a short position. Now, let's find the amount of money required to open this short position. We multiply the position size by the entry price. 0.102 multiplied by 87,323. That gives us a position value of $8,906.946. So, even though our total trading capital is only $1,000, the position we want to open is much larger than that. If we still want to stick to our 2% risk rule, the only way to open this trade is by using leverage. Now, let's calculate the margin required if we use 20x leverage. We divide the total position value by the leverage. 8,906.946 divided by 20. That equals $445.347. So, with 20x leverage, we only need about $445 from our $1,000 capital to open this trade. The remaining capital stays unused and available in our account.
Now, in the two examples we discussed above, when we use 20x leverage, we are using more than 20% of our total capital for a single trade. And let me be very clear here. That is a very professional and very normal thing to do. But we also need to be aware of an important fact. When we use leverage, we are actually borrowing money from the exchange to open the trade.
Let's look at a simple example. We had only $1,000 in our trading account, but to open the Doge long position, we needed $4,936. So we used 20x leverage and opened the position by using only $246.8 from our own capital. That means we effectively borrowed 4,936 minus 246.8, which is $4,689.2 from the exchange or broker. And of course, they don't lend us money as charity.
Now let's talk about what happens if the trade does not move as expected. If the trade moves in our direction, everything is fine. But if the trade moves in the opposite direction and the loss keeps increasing, the exchange starts covering that loss using our remaining capital. When the margin is no longer sufficient, the exchange will automatically close the trade. This brings us to a very important concept, the liquidation price. Liquidation price is the price at which the exchange will automatically close our position because our margin is no longer sufficient to keep the trade open. When we use leverage and commit a large portion of our capital as margin, there is always a liquidation price. We don't have to calculate it ourselves. Most exchanges show the liquidation price when we open the trade and continue to show it while the trade is running. Liquidation is not a problem if we manage risk properly. In well-managed trades, the liquidation price is usually far away from the stop-loss price. But this part is very important. If we open more than one trade at the same time using leverage and using a large portion of our capital, such as 20% per trade, the liquidation of one or more trades may be reached before the stop-loss. In that case, the exchange will automatically close the position and we may experience unexpected losses, even though our stop-loss was placed correctly. So here is what I really want you to remember. If you calculate the 2% risk properly, open one trade, use any leverage you want, and place the stop-loss correctly when opening the trade, then there is no problem at all. Everything is fine. But if you are going to open more than one trade at the same time, even if each trade risks only 2%, you must be very careful about the liquidation price. As an experienced trader, I sometimes run more than one trade at the same time, but only when I have very high probability setups, for example, setups with over 90% win rate. But if you are a beginner, I strongly recommend this. Stick to one trade at a time. Calculate position size for 2% risk, place the stop loss when opening the trade, always check the liquidation price before confirming the trade, and make sure it is far away from your stop loss. If you follow these steps, you don't have to worry about liquidation at all. I hope this video was helpful to you. If it was, a quick like, a subscribe, and a share really helps the channel grow. Thank you so much for watching, and I'll see you in the next video.